If there's a broadening of markets, that usually means that something has to come down. Someone has to lose.
From pending rate cuts to new policies and growing global implications,
Saudi Arabia is really running out of fiscal room.
the 2025 market is somehow still growing despite these mounting concerns.
Yes, it absolutely will end in tears at some point, but I don't think 2026 is the year.
Marko Papic is a macro and geopolitical strategist at BCA Research.
2026, I'm going to take a swing at this and say that sector is going to do really well.
He shares the top 3 sectors he's watching for some major market moves in the new year.
And so from now until May, it actually could be a very difficult start of the year. My story is much more about second half performance than first half.
Plus, stick around for his prediction on where the S&P 500 could be this time next year. Let's dive in. Marko, so excited to have you on the show today for a really great conversation looking ahead to 2026. First, I want to talk about what you offer for our viewers. It's a little bit different than normal. We're not going to talk about those specific stocks, but more a broader look at sectors that we should be looking at in 2026 that could see some major moves. So first off, just share a little bit about what your specialty is.
Well, thank you for having me on. I am what I call a geomacro expert. What that means is that I try to combine politics and geopolitics on one side with markets. Now, I do this for institutional investors, so pension funds, sovereign wealth funds, hedge funds, and so on. And my job is not really to predict, whether Google will outperform Microsoft. I don't know how to even begin doing that. I'm a top-down strategist, so I really think in terms of big assets, S&P 500, the US dollar, oil, gold, Euro USD, those kind of things, the 10-year treasury yield. And the reason that this really is important is that if you kind of figure out 3 out of those 5 assets correctly, you can pretty much know what's going to happen in the world, whether it's, Swedish equities or nickel. You will have a good basis of understanding where the world is going. So I try to figure out where the world is headed for my clients, and then they take it further down the assembly line of finance and pick specific securities.
So interesting. And I'm excited you're going to be sharing 3 sectors with our viewers today that you are watching for 2026 to see some major moves in the market. And talking about those predictions that you just talked about, looking at those bigger ones, you're also going to share your S&P 500 prediction for 2026. And you had a really strong, successful prediction for 2025. Break down a little bit about what your prediction was for 2025 and how well that's doing so far.
Well, it is only December 2nd, Bridget, so let's not jinx it, But no, I set a very high bar for 2025. I was extremely bullish. I set it at 6,950. So I think we're not going to make that in the next 20 days or so of trading. So we're going to fall short of it, but directionally it was correct. And last year I was actually super bullish as well. I think my target for 2024 was 5,500. It wasn't bullish enough. So it wasn't like as high as it could have been. Really, since 2020, I've been almost entirely bullish, except for a little bit at the end of 21, early 2022. But other than that, it's been very easy in my view to be bullish. And now it gets a little bit harder.
Yeah, we are going to share at the end of this video your 2026 prediction and whether you're still bullish or not on the economy and on the market moving forward for the new year. But first, let's get into those sectors that you are specifically watching. Some really good advice for our viewers to be watching as they are looking at stocks for the new year. What is that first sector, Marko, that you're looking at and watching for 2026?
As I promised, I combined geopolitics, politics, and finance. And this year, for most of the year, I've been pretty bearish on oil prices. In fact, I told my clients not to go long oil, even as Israel and the US were preparing to go to war with Iran. And there's a lot of reasons for that. First and foremost, Iran just doesn't have the capability to respond to an attack by the US. Their ability to close the Strait of Hormuz is really limited. And demand has been okay-ish. Meanwhile, Saudi Arabia has had a real geopolitical imperative to boost its production. They want to be on the right side of President Trump, and President Trump is almost singularly focused on boosting global supply of energy so that American inflation goes down. So that's the story of 2025. 2026, I'm going to take a swing at this and say that energy sector is going to do really well. Part of the reason is that oil prices are likely to see some upside. And the reason for this is that Saudi Arabia is really running out of fiscal room. The Saudis are They're doing a lot of nation building. They're doing some really incredible stuff domestically. They're building, new industries. They're building a whole new region. Imagine if the United States of America just said, you know what we're going to do? We're going to take half of South Dakota and build a new giant manufacturing part, like just totally out of nowhere. This takes a lot of revenues. And so for that, they do need oil prices to be a little bit higher. So I actually think that Crown Prince of Saudi Arabia, Mohammed bin Salman, came to the U.S. and told this to President Trump in middle of November. I think he told him, like, hey, listen, I don't think we can keep production as high as it has been. I think that this is motivating some of President Trump's assertive policy towards Venezuela in the interest of perhaps finding a new source of oil somewhere. Bottom line is I think that $62 on Brent crude is too low. And so I do think we get to 70, 75, not too high because there's still demand and growth concerns. And so I think that'll be a nice little boost for energy companies, including those in the US.
Such an interesting way to look at the oil market, talking about all the political factors that you just mentioned. I love having you on, Marko, and giving us a different perspective. I want to dive into the energy sector a little bit more. You mentioned a lot about oil. I'm wondering if your prediction includes any other areas of energy, largely because last year, the same time in December, we had many guests on talking about how energy was going to be the biggest thing in 2025. And we saw that maybe in January, February, but then the whole market declined in April. And I don't know that it really saw the kind of growth that we were expecting again this exact same time last year.
Yeah, growth of production. Yeah, that's what surprised. I mean, what surprised was that Saudi Arabia was so comfortable driving OPEC production higher. I think that they've done that in order to be on the right side of the Trump administration. I mean, that was a really good move for them. They're helping President Trump accomplish low inflation in the US, but they also have their own domestic needs. I think they're running out of time. Now, one thing about President Trump to really understand is that he has actually been a terrible president for the energy sector, which is confusing because he's very pro energy. He's drill, baby, drill. But think about that for a second. Drill, baby, drill is terrible for energy companies because then they have too much product, the product price goes down. So this is where actually President Trump, if you compare him to other presidents from George W. Bush on to Biden, has actually been the worst president for the performance of the energy sector. Ironically, Joe Biden has been the best president for the performance of energy sector because he makes it so difficult to produce oil. So what's good for the consumer, what's good for the median American is not necessarily what's good for the energy company itself. Again, though, I think in 2026, we're going to see Saudi Arabia kind of have to, say, look, we love you guys, love America, love helping you bring your inflation down. But we also kind of have to build a lot of stuff domestically. So we need the oil price to go a little bit higher. And I think that will be a relief for the U.S. energy companies. Natural gas, too, something to look at. I think natural gas prices should continue to go higher, partly because of all this data center stuff we're building in the U.S. I think that's just a lot.
Yeah, also a really interesting point about just because consumers might enjoy those lower prices at the pump, it doesn't mean it's good for the gas companies. And if you're an investor, you want to think about that for sure in the new year. A really good discussion on the energy sector. Last question on energy before we move on. Thoughts on nuclear? Where do you think nuclear could go in 2026?
To me, it's very, very difficult for me to give any thoughts on specific nuclear-related companies. To me, it's only really uranium that I can really comment on. And I would say that uranium prices could go higher because, yes, the whole world is building more nuclear power plants. From that perspective, if one of your listeners wants to get a little bit exotic and find a uranium ETF, I'm okay with that. But specific companies that are related to the nuclear build-out, I'll be very careful with that. It takes a long time to build a nuclear power plant, and we don't know really what the demand for that in the United States will be. Because you've got the Trump administration in power for another, let's say, 2.5 years or so. We don't know who wins the 2028 election. We don't know what the policy towards nuclear power will be. So I would rather approach this from a global perspective. And so the easier way to play this, rather than picking a particular stock that's related to building out nuclear power, I would rather just invest in uranium.
Certainly, uranium is one way to invest in the growing bullish outlook for nuclear energy, but there are so many companies to choose from in this space. Some of them made our list of the top 7 nuclear stocks right now. If you're looking for some specific stock ideas, you can scan this QR code or click the link in the description to get that free report on nuclear stocks right now on MarketBeat.com. All right, Marco, so you're bullish on energy making a big comeback in 2026, even though it's had a really rough year this year. I'm curious what that next sector is that you're watching in the new year.
Well, I'm really looking at real estate. And when I say real estate, what does that mean? Well, you can invest in home builders. There's various ETFs to take advantage of that. But I would actually look at financials and consumer discretionary, those two sectors of the US economy. Why? Because when people start investing in homes, they tend to also associate home buying. Obviously, home builders will do well, but consumer discretionary has to do with those kind of big ticket items, what we would call durable goods. So whether that's a home or a washing machine. And so I like consumer discretionary. I also like anything that has to do with home building, sort of the big ticket, big box stores that you would go to for home improvement. And finally, financials. Why financials? Well, financials do well when people take out mortgages. Mortgage is like a chocolate bar that a chocolate company makes for a bank. Banks issue mortgages. It's a product. They make money on those products as well. So those are kind of the things that I really like. Why? I said earlier in our conversation that it's more difficult to be bullish in 2026, right? It was easy for me to be bullish the last 5 years. And the reason I say that is because I could look at a chart. I could look at data and tell you, Bridget, that yes, Americans are flush with cash. There's $5 trillion worth of fiscal stimulus that we did after the pandemic. Now that is over, and that's no longer the case. I mean, in fact, the media is focusing on this K-shaped recovery. And so to extend this economic cycle, there's really two things we can do. First of all, we don't have to extend it. We can just have a recession and people lose their jobs, and it's very painful. I don't think that's what the administration is going to do. In fact, what I think President Trump will do is he will capture the Fed by about May of this year when Jay Powell, of course, is replaced by somebody loyal to the president. And I think at that point, the president, with significant bipartisan support, I would add, is going to look to drive borrowing costs for Americans down, particularly when it comes to buying a home. So I actually expect a revival of housing activity in 2026. And yes, it's both a macroeconomic and a political call. Macroeconomic because there is pent-up demand. The average age of a home buyer in America today is 51 years old. Yeah, like nobody young can buy a home anymore. They can't afford it. So it's a political issue, but there is pent-up demand. And I do think the Trump administration will seek to lower those costs. It's one way to fight this narrative that affordability is a big political risk to the president. And when we talk affordability, it's not about inflation. It's not about how much like a toaster oven costs. It's not like you walk into a Walmart and you're like, oh my God, the toaster oven is so expensive. Like nobody's angry about toaster oven prices. People are angry about big ticket items. It's really expensive to take kids to college, to send kids to college. It's really expensive to get daycare, and it's really expensive to own a home. And that is the biggest ticket item. So I think you will see the administration laser focused on that, and I think they'll be successful. I think they'll drive those costs down, and I think they'll generate housing activity. Now, whether it all ends in tears 3, 4, 5 years from now, I mean, that's for some other administration to deal with. My message to you right now is yes, it absolutely will end in tears at some point, but I don't think 2026 is the year for that to happen.
So much to break down in all of that. You gave us two sectors, again, talking about more consumer goods, home builders, any product that has to do with that home ownership, building a home, improving a home, and then give us the second sector, which is financials. I'm going to go into the housing sector first. There's been some individual stocks, some of those big box stores you mentioned, that had a really terrible year in 2025. What's going to see that turnaround in 2026? Is it just the demand? What's going to turn those around?
Absolutely. Yeah, it's mortgage rates. If you're hesitant to believe my view, which is totally appropriate, I mean, I do get things wrong and right. But if you want to sort of get a gauge of whether or not this makes sense, just take a look at mortgage rates. Right now, the 30-year fixed mortgage rate is about 6.2%. Now, it's come down from almost 7%. And so if it dips below 6% over the course of the first quarter, that should incentivize more Americans to start dipping their toes into the housing market. And so that's where some of the big box stores should do well. The ETF also that I'm looking at, both as an investment opportunity, but also as a gauge of whether or not I'm right, is XHB. So that's your home builders. That's something to also, track closely. That and mortgage rates, just track it closely. Also, if you just want to explore my view, go and talk to a mortgage broker. Just pick up the phone, call them, and ask them, hey, what kind of mortgages could I get? You're going to be surprised if you have that conversation. You're going to actually get some products that get the mortgage rate down to like 4.8%. Now, yes, it's variable, it's this and that. You can buy basis points by putting a little bit more down. But listen, the bottom line is no one's buying homes at 6.2%. There's various other products, and the acceptance of variable mortgage rates is rising. So consumers are becoming much more comfortable with this. And why wouldn't they? They have President of the United States of America telling them that he's going to declare a housing emergency, that he's going to offer 50-year mortgages. It's clearly the impetus of the administration is to bring mortgage rates down. Why would you not take a variable rate to that point for the next 5 years?
Interesting perspective. I think I want to talk about the flip side of this. For those who are homeowners, that could be a lot of our viewers right now watching. They are in their home. The value of their home has gone up substantially over the last 5 years, really even longer than that. Some people out there, some economists are calling for a potential collapse in housing prices. I know that's the goal, is to make housing more affordable. But for those who are homeowners, is there any fear to be had in what this could do to housing prices in the U.S. this coming year?
So, no, because what would need to happen is we would need to have more supply. Now, there's pockets around the world, around the U.S. where supply has come online way too much. For example, Central Texas. I'm sure you know, Bridget, everybody and their dog moved to Austin. Joe Rogan moved to Austin and Elon Musk moved to Austin. Everybody's moved there. Central Texas has way too many homes. There's been a deflation in real estate prices. But Texas is also the kind of place where if you wanted to drill for oil in your backyard, you could without really any licenses or regulations. Here where I live in Santa Monica, California, you can't build a shed without basically applying for 17 different regulatory licenses. And therefore, what I would say is that unfortunately for most young people in America looking to buy a home, unfortunately for them, most of the United States of America is actually like California, not like Texas. Fortunately for homeowners, what that means is that the supply has not caught up with the pent-up demand. So when mortgage rates come down, what you're going to see is a deluge of demand. The other thing that's going to happen is a lot of baby boomers who are sitting on hundreds of thousands of dollars of home equity that they didn't expect, it fell from the sky over the last 5 years, they're going to be able to dip into home equity lines of credit by using lower mortgage rates to unleash some of that appreciation and then, give $100K to Jack, $100K to Jill, their millennial kids, go off, buy your homes, and then blowing the other $100K on a nice long trip to Europe.
Oh, that sounds nice right now, especially. Let's get to that last sector a little bit more, just to dive into the financial part. I think you make a really great argument that if mortgage rates come down, that's going to mean a lot more business for banks selling these different mortgages. Everybody and their mom are going to refinance if they bought during this higher mortgage or higher rate period. Is it just that factor that has you bullish on financials for the new year? Or are there other factors that you're watching that could be bullish for the financial sector?
Well, we're seeing some of the lending activity pick up, actually, just broadly to privates and to the corporate world. And so I do think that borrowing activity will accelerate, particularly if President Trump and his Fed, and I'm saying his Fed, once Jay Powell is out of office in May, I do think that what they're going to look to do is steepen the yield curve, which tends to benefit financials. Complicated story, but the short end of the curve comes down as the Fed cuts rates. The long end stays relatively elevated, not too elevated. I'm not bearish on bonds. I don't expect some sort of a carnage. Why is this important? It's important because banks themselves, they borrow at the short end. When you hear in the news Fed's going to cut rates, is that going to really help you? Maybe. It should, but it really helps banks because they borrow at the short end and they lend at the long end. So it's really the banks that are going to benefit. Now, they're going to give you the loan because they're happy, but it's really good for the financials if the yield curve steepens, and I think it will. Now, why would it not steepen? It may not steepen if the long end comes down quite a bit as well, and that would be because we have a economic crisis or something like that. We have a recession, but I don't expect that to happen. I think yield curve will be steep enough for good reasons, for bullish reasons, and I think that will benefit banks.
We are about to to get to your S&P 500 prediction for 2026, but first I want to talk about kind of a bonus sector that you have for our viewers today, and that's taking into consideration where the US dollar is right now. And we talked a lot about US-centric things right now, but you have more of a global perspective to share too.
I think most of your viewers are going to be very overweight US. That's what we would call it. I mean, for most of your viewers, they're going to be like, what do you mean I'm overweight US? I'm an American. I live in the US. My investments are in America. But that's really worked for the last 14 years. Has not worked this year. So let's say that you're sitting at home listening to this and you're like, what are you talking about? S&P 500 is up almost 20%. I'm doing well. Yes, but had you invested in Europe or China or emerging markets, you would have made a lot more, particularly because the US dollar collapsed 10% this year. Now, you didn't feel that because everything you do is in the US dollar. Your brokerage account is in US dollar. Your grocery prices are in US dollar. Your retirement income or your salary is in US dollar. But there was a decline in the US dollar relative to the other currencies, particularly the euro. And so you missed out. You lost out on basically a 35 to 45% return on European stocks. And no, I don't think this was just a flash in the pan. I think this is the next 5 years. It doesn't mean that the US is in some economic trouble. It doesn't mean that it's in a bear market. In fact, I have a positive outlook for the S&P 500 next year. I did for this year as well. It's just that you can make actually more money abroad. Part of the reason goes back to my point about President Trump and the Fed. I think they're going to try to stimulate. They cannot stimulate fiscally anymore because the bond market's very mad at us for overstimulating under the Joe Biden presidency and then before that, the Trump presidents. And so the only way to stimulate the US economy is monetary policy. But that will drive the dollar, I think, further down. And so I think you want to take part of your portfolio. Like, if you don't believe me, if it sounds crazy, make it a small part. But take some part of your portfolio, sell the US holdings you have there, maybe 10% of your portfolio. I would recommend 30 to 40% of your portfolio, but let's not get crazy and just buy broad indices abroad. Particularly Europe, I think it's the safest actually. And I think you will enjoy the benefits of that currency differential. So you're paid in dollars, but if your investment is in the euro goes up, you're just going to make money purely because that happened. But on top of that, you're also owning an asset that will appreciate if growth is fine, if, companies are selling and so on and so on. And by the way, Europe doesn't even have to grow for you to make money. Germany's effectively been in and out of recessions for the past 2 years. The German stock market, the DAX, is at all-time highs. Why? Because they sell a lot of stuff. To who? To us. So it's fine. You're just getting exposure to earnings of really good companies, and you're also getting exposure to a non-US dollar currency.
Something really important for investors to think about this year. It's something you can look into yourself too. Just go check the performance of some of these other markets to see what Marko is saying here. So very interesting. Let's get back to the main US market. Let's hear your S&P 500 prediction for 2026. You already said you are bullish in the new year.
Yes, and it's kind of embarrassing because you made a big deal about it, but it's like, it's not that exciting. I'm sorry about that. I think that we have single-digit returns in 2026. It will be really difficult to have 3 straight years of double-digit returns. It would really have to mean that the AI story, which curiously we didn't mention once, maybe refreshingly for your viewers, because I'm sure they're sick and tired of talking about AI. I'm not a big AI optimist. I don't think there's a crash in 2026, but I think eventually there will be. And I think that, as you can see from the sectors I'm recommending, I didn't mention tech once. I'm looking for the broadening of markets. If there's a broadening of markets, that usually means that something has to come down. It's just the way life works. Someone has to lose. Unfortunately, because most of investors in the world are overweight tech, if suddenly financials and consumer discretionary and energy do well, it probably also means that tech has not really done that great. And that will argue for a single digit return on the S&P 500. So my target is 7,500. We're almost there. So that tells you that it's going to be a pretty volatile and tough year, a very stressful year. First 2 quarters of 2026, I'm actually thinking of maybe even being tactically bearish. I think a lot of the things I've articulated today are not going to be clear until May, June, July of next year. And so from now until May, it actually could be a very difficult start of the year. So that's what I would also warn investors. My story is much more about second half performance than first half.
Very important note there. Take this is a long-term full year look, not just the first couple of months of 2026. Loved the conversation today, Marko. Thank you so much for sharing a lot of important knowledge with our viewers today. Appreciate your time.
Absolutely. Anytime. It's a real pleasure, Bridget, and hope to talk to you soon.
Yes, and if you want to hear more from Marko, we have a link in the description too, where you can learn more about his research and the way he looks at the market. Let us know your thoughts in the comments. We want to hear from you on this perspective. Do some of those sectors resonate with you? Does the discussion on European exposure resonate with you? I'd love to hear from you in the comments. Thanks again for watching, everyone. As always, happy investing.